Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Look, we're still seeing the upward drift in equity prices that we fully expected, and I did say several days ago we're going to get 3 to 7 days of bounce here as the pendulum swings back against all that selling that we'd enjoyed on the way down, and that we move this week into important economic data in the US. The inflation CPI number, most people are expecting a number around 8.18%. I think it could be a little bit higher, like 8.2, 8.3. But regardless, it will say that it will be further encouragement that inflation in the United States has peaked. And people will get very excited about that because they'll see it as the, if you like, the first real light, although they tried to see it last time and it didn't work. They will again see it as the first real light that inflation has definitely peaked, or further confirmation of that, and therefore the Federal Reserve will have to pause interest rate hikes or reduce them or even pivot. Now, we've heard all of that nonsense before from people, and every time it turns out that you get a rally that's fantastic to sell, as it's very clear the Federal Reserve wants the CPI rate down at 2 to 3%. So at 8% or higher, we're way out of the ballpark, and that's going to do nothing to slow Fed rate hikes of 75 points at every meeting, as we've correctly forecast previously would be the case and continues to be the case. But in the interim, between now and the next 75-point rate hike, the bulls will be saying, oh, they might pause, it might only be 50, that's a reason to buy stocks. All the time, the US economy is in trouble. Now, we're going to get retail sales in the US on Thursday, and that retail sales number could well be a negative, actually. So we had a 0.0 result in the last month. For August, I wouldn't be surprised if we see minus 0.2, minus 0.3%. A negative number for retail sales is very likely. Look, if it happens to be up, well and good. The consumer is just hanging on, but I think there is real risk that it will be to the downside. That again will be spun by the bulls as a reason for the Fed to be more cautious and therefore to buy stocks. Now, all of that argument is predicated upon the false belief that only interest rates and interest rate outlooks determine where stock markets go. The stock market didn't fall 20% in the US this year because interest rates were going up. It fell 20% because the economy is so dysfunctional, dislocated, and under a lot of pressure. So that slowing in economic outlook means that earnings are going to be soft going forward. We have seen the peak for the earnings boom coming out of the post-COVID government stimulus, free money environment from the Fed, and so earnings will be moderating. Don't forget, during that period, corporations could raise prices, fatten their profit margins substantially without losing market share because everyone felt that price rises were okay because they had to do with supply chain disruption and other COVID staffing issues and all that ongoing matrix of complexity around COVID. So they got away with fattening the profit margin, and some of it was appropriate because they needed to factor in greater uncertainty than had previously been the case. So some fattening of profit margins was appropriate, but I think it was a little bit overdone, and that's why we had earnings and inflation both going up in the US at the same time. Now we've seen inflation kind of peaking, and we are going to see earnings start to moderate as well because they won't be able to fatten the profit margin, raise prices the way they were before, and that of course will help the inflation number to come down. But it all comes back to a weakening US economy. So that retail sales number on Thursday, if that's a negative, there might be a hiccup rally in stocks, but then people will stop and think over 24 to 72 hours after that, oh, the US economy could be in more trouble than we thought it was, which is what I've been forecasting all along. You'll remember I forecast a recession for this year last year when everyone thought it was going to be nirvana, 4% growth this year for the US economy, and we've seen 2 negative quarters already in the United States. So I do think it is still a dire outlook for Main Street real-world economic environment in the US. Wall Street tries to spin things into positives, tries to think that, oh, if the Fed has to slow rate hikes because the economy is plummeting, that's good for stocks. Well, no, it isn't. It's good for stocks in the moment, in the headline perhaps, but it's not actually good for stocks and corporate earnings long term. And that's why I think any such rally will be a rally to sell. But for the moment, the market is trying to do just that, to rally in the short term. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.